Hello, today's June 21st, 2024. Thank you for joining me for this edition of FedWatch. The data came out this week and it showed what we have been expecting, and the economy is sluggish. Industrial production data came out, and manufacturing, mining, utilities, none of it is doing well. The first two are essentially flat. We're seeing a little bit of pickup in utility production. That's not a big surprise, but it certainly isn't strong. And manufacturing really is just getting a little bit weaker. That 312 rate of change slipped to minus 0.5%. So we're not seeing any momentum building in that sector. Retail sales data came out, and that didn't look great either. The 312 potentially slipped into a phase C situation, and at 2.9%, that's the slowest quarterly rate of rise year over year that we've seen in 8 months. 1212's at 3.3, not going in place fast, except maybe edging downward. And that's in nominal dollars. So you back out the rate of inflation, and we're not seeing it much movement at all in retail sales. Housing data came out. Single-family housing starts data was not good. We saw 112 drop to minus 2.8% for single-family starts. And part of that was last year was so very strong, but it was also just a weaker than normal increase or change really from March to April. That stat for the month-to-month change of minus 6.2% was way below normal. So it was just a bad month for single-family starts. I thought maybe we'd see some better news in existing home sales, but that's the overriding status there remains negative with the data trend in recession. All the rates of change are below zero, so they're nothing but negative numbers. We saw a month-to-month change, April to May, that was weaker than median. Overall, it's very reminiscent of 2011, which was not a great year, although it improved in the second half of the year. And that could very well be what we're looking at here. We'd be consistent with that forecast. So what does all this mean for interest rates? Unless we see significant change in wage inflation, which we are not anticipating, we'll probably get that one decline in September, maybe another one toward the end of the year. Some more in the first half of 2005 remains on the table, but nothing great. Our core rate of inflation, as we forecasted for the personal consumption expenditures, still gets low enough for the Fed to maneuver interest rates downward. Really, it's going to become interesting. Are they going to look forward into 2005 when they start gauging monetary policy, or are they going to look at where we sit today? From our perspective, just remind you, there's a whole nother round of inflation coming at us, probably beginning late 2025 or certainly in 2026. So any drop we get in interest rates will be a respite. Grab them while you can. Because they're going up, and they're going up significantly or appreciably higher, I should say significantly. That's the take on this week's data. The economy is muddling right now more than anything, but wages are keeping interest rates high, and we're not likely to get a tremendous amount of relief. We have our July webinar coming up. Al and I are going to be talking about the next 5 years in much greater detail. I encourage you to go on our website, itreconomics.com, and take a look at that information. And we'll give you a lot more detail on what we expect and when we expect it and what it all means. Thanks for joining us for this edition of FedWatch.